Hey, so Andrew, did you hear about Cathie Wood, the managing director and chief investment officer of ARC, writing an open letter to Federal Reserve? Did you hear about that?
Well, everybody knows Cathie Wood. Cathie Wood is a person that she had the fund ARKK. That was an emerging market, and it was just rallied significantly in 2021.
Emerging technology.
Emerging
Yeah.
technologies. And then she was the big advocate of Zoom and Python and so many other companies. And then she actually has a famous word that she said, the bottom is in January 27
Yeah.
this year. So
Yeah.
the bottom, she thought that the bottom is January 27. But I know her fund is extremely underperforming. So I think it's down like 80% from the highs. And I know she's under a lot of pressure. No, but what's the letter about?
Yeah, definitely. I mean, since you went there and it started, I have the chart of arc up, and so this is this massive move, and now it's even below the 2019 highs. So it's far below that. Now it's trading at $35.70.
Jesus.
So definitely talk about like .com bust, kind of a parabolic move up and a bust. Well, anyway, she sends a letter to Federal Reserve, an open letter in her website. I have it up in the website here, and basically she talks about how the Fed is not really data driven. So she basically put it in the quotation mark, saying data driven Fed is not really looking at real time data. So and then she kind of go ahead and quotes some of the commodity prices. So gold is down 18% from the peak, silver is down 31%, lumber 74%. Iron 45%, dram 46%, copper 31%, corn 16%. So pretty much all the commodities are down tremendously. And basically she's talking about how
So data driven means that the Feds are looking at inflation number and unemployment. So they want the inflation number to comes down and unemployment goes up, so to cool down the economy. But the point that she's making is that these two are actually lagging indicator. Means that it takes a while until the impact of the raise and tightening to show themselves.
yeah.
That's what she's trying to say, that you're actually looking at in the rear window.
At least for inflation, right? So she's saying, could it be that unprecedented 13-fold increase in interest rate during the last 6 months, likely 16-fold to come in November 2nd, has shocked not just the U.S., but the world, and raised the risk of deflationary bust? And then she argues that inventories are building up, so we're actually heading into a deflation, which is not a bad thing, right? That's what the Fed wants, right? Fed's, in order to cool down inflation, you can't fight fire with fire. You got to fight fire with water, right? So in order to bring down inflation, you need a deflationary bust.
I would like to invite all of our members to join our first ever live trading workshop. It's a full day event in Fort Lauderdale in Florida. We're going to have live trading with some of very best traders in the community, walking around you, helping you to make the decisions while you are in the trade, while you are practicing, to make you a better trader. If you're interested, sign up bearabletraders.com/workshop. We have few spots left, and I'm really looking forward to see as many of our traders in the event. I think it's going to be amazing.
That's pretty much what.
But that deflationary bust comes at the expense of a lot of corporate margins. Like Nike, you see a lot of these retailers, they're getting hit really bad because the inventory is building up. Consumers are very anxious about the inflation. The purchasing habit of the consumer has changed, and that's impacting the biggest companies and the profit margin of the companies.
Yeah, it's very interesting. I was listening to a podcast. I think someone from one of these big banks was talking, and he was saying how a 1% increase in the debt payment and in interest rate is actually more painful on lower income families than a 1% increase in inflation. So by raising rates so aggressively, Fed that seems to be trying to help the lower income people with the inflation,
but they actually hurt them more.
Actually hurting them more, and that's kind of goes into Elizabeth Warren. What's her name?
Senator Elizabeth Warren,
Senator Elizabeth Warren talking about, hey, you can't be this aggressive, and you're actually hurting the middle class. I don't know. I haven't actually looked at the data. I don't
So
know if
it's possible because all of the lower income people, they probably have credit card debts and the mortgages that they have to pay. So you just keep putting pressure on the interest rates. So to cool down the economy, part of it, the big corporations are getting hit. Another part is actually the lower income and middle class are actually getting very smashed more. Maybe their argument is in the long term it's better for them. It's painful for some households, but in the long term it's better.
You're absolutely right, yeah. I definitely agree. That's definitely the case.
But I know a lot of people personally that they have $50,000, $60,000, $70,000 in credit cards and they're paying that and the interest rates on those ones are going up. Yeah. Student loans, a lot of people are very, very heavy on student loans and they want to build something. To be honest with you, the Federal Reserve people are the smartest bankers that you can imagine.
Yeah.
And they should know something. But are they stuck in something politically right and they have to do this, otherwise people killing them?
I don't know. Yeah, that's it. I don't know. What do you guys think? Let us know what do you think. Just looking at our calendar, Andrew, on Trading Terminal, we got some big important information coming out on Thursday. CPI month over month, year over year, as well as initial jobless claims. So big day on Thursday. Mark your calendar. Bank of Canada is meeting next week. They're probably going to raise by another 50 basis points. And then Fed is meeting November 2nd. Yeah. And then the chance of 75 basis point is at 77%.
So another 75 percent points.
Yeah.
Jesus.
Yeah, so it's happening. Anyway, let us know what you guys think. What do you think about the letter, the Cathie Wood letter?
I mean, I told you, it's not the bottom until somebody cries on CNBC. And Cathie Wood started that, and we'll see if she's actually crying on CNBC. But I think Feds are too aggressive. Really, they're smashing the economy and everything. Look at the bond market. Look at what's happening in all across the world. It's not only U.S. here. You're just making U.S. dollar strong. It's the basis for a lot of global economy. And you're actually putting pressure. You're actually exporting inflation and crisis to the other countries. Maybe you got to wait a little bit. Maybe you should wait a little bit until supply chain opens up and give time until the inflation cools down. But I think Feds are concerned that the inflation becomes sticky and it becomes really part of the every business.
Yeah. Well, all right, everyone. Thanks, and we'll see you again. If there's any news comes up, we'll let you know, and we'll try to keep it updated.
Very exciting. This week is actually very scary Thursday morning. You know, I don't know if I cannot see another NASDAQ 4-5% drop. It's just...
Yeah, this is, by the way, the rate distribution, Andrew, for end of next year. So, you know, it's definitely a normal distribution. A lot of the analysts are thinking somewhere from 4.5 to 4.75 to 3.75 for next year. So that's where majority of distribution is today. Anyway.
Yeah, so remember, right now until the end of next year is just who can hold it longer. All the developers, all the investors, they're all just trying to preserve their money and not just getting destroyed. So we're really looking forward to what Feds are doing and hopefully this inflation coming down. And to my American friends, spend a little bit less. Spend less a little bit. Help into lowering the inflation. Thank you so much, guys.
All right, everyone. We'll see you in Florida.
Cheers.
Cheers. Bye.